Well, the economy's been quite boring recently, hasn't it? There's not a lot to talk about. Of course, it hasn't. I mean, it's pivotal in every single thing that we do as developers and investors. So, what we thought was appropriate for 2023 for January, kickstart the year, was to get 4 experts in their own right to come and talk and discuss what their views are of the funding and financing marketplace, what the banks are thinking, where the economy is going, and what we can start to expect in 2023. Of course, nobody's got a crystal ball, but these guys are really immersed in this on a day-to-day basis. So, gentlemen, how are you? And a very warm welcome.
Morning, everyone.
Morning.
How are we doing?
So if we just go through just in quick order, just 20, 30 seconds, if you could just introduce who you are and your company and what you do. So can we start with Nick Holding-Parsons?
Yeah, thanks, Mark. Morning, everyone. So I am a director at LEXI Finance, set up the business just over 3 years ago. Jan 2020, so interesting times for us. We source and structure debt and equity for any real estate mandate across UK and Europe, whether that's ground up development, conversion, or investment acquisitions or portfolios, typically loan size from 3 to or as high as 150 million. Got access to a number of different sources of capital.
Great, thank you, Nick. And Simon Das. Hi, Simon.
Good morning. Hi.
Hi.
I'm good. Thank you. Thanks for the invite. So I'm the managing director of 978 Group. I've been in real estate for getting on for 15 years now. And over the course of that time, I gradually built a group of companies. Ultimately, we're a property services and investment business. And I spend most of my time in my finance brokerage, 978 Finance. We work with property investors and developers all over the UK and work quite a lot with international investors who are investing in the UK. And we provide commercial finance, so anything from bridging to commercial buy-to-let mortgages and development finance too.
Great, thank you, Simon. Michael Primrose. Hi, Michael.
Morning, everyone. How are we? Michael Primrose, Property Finance Collective. Do what we say on the tin, really. Property finance, so anything from commercial mortgages through to development finance. Obviously, many of you will know me obviously from here. But mainly we'll know our specialism sits firmly within development finance. It's what we're best at. We've got members of the team who actually worked with development lenders, as in they've worked for development lenders. So development finance is, without a shadow of a doubt, our absolute expertise. So yeah, that's kind of my rusty elevator pitch.
Great, thank you, Michael. And good morning, Adam Knowles and Rob Hammond of Brick Owner.
Mark, Adam and Rob they're in the office today, but they've just had a fire alarm go off.
Oh,
so
okay.
They'll get back on if they can, but I'm not sure it's likely.
No problem. Okay, well, moving on to so Nick, Simon and Michael. Obviously, we've had, since Liz did a piece of work in September, the economy's changed. I wonder if each, and we'll keep in this order of Nick, Simon and Michael, I wonder if each of you could just give your high-level view of where the current market sits and what you're seeing from the funders at the moment and initial thoughts for 2023. Bit of a wide-ranging question, but over to you, Nick.
Look, 2022, there was a lot going on. We've obviously got a war over in Eastern Europe, and I think we've gone through a fair few Conservative governments. So that's not helped the real estate market. As you touched on, the mini budget was a massive upset. Swap rates and gilts just got pushed out dramatically, and it just didn't give the banks time to prepare for that. We all knew with inflation high that interest rates were going to increase, but I just don't think everyone's quite prepared. In terms of the lending market and where we are now, I think there's still a huge amount of liquidity in the market. There's a number of lenders still very active and looking to deploy capital. The cost of capital has obviously increased. There's nothing we can really do about interest rate at 3.5%. I think internally we think it might go slightly higher to 4, maybe 4.5 in the first 2 quarters of this year. But there's still a lot of money to go around. Obviously, 2020, a lot of people were keeping their powder dry, and there's still a backlog of cash to be deployed. Banks can't just sit on money and wait. They have to make a return themselves. So, yeah, there's still a lot out there, but obviously the financials just look slightly different, where we were seeing development finance typically challenger bank level at 80% loan to cost, 65% loan to GDV, anywhere between late 5s all the way through to early 7s. I think's been pushed out to kind of 8.5 to 10%. Now, what does that mean for developments? Well, ultimately that means it's going to eat into profitability on the back end. I think we've started to see land banks, vendors get a little bit more nervous, and certainly chipping later on into the process has started to come into effect because schemes just aren't profitable with GDVs and mortgageability becoming quite hard at the moment, given the cost of buy-to-let or your personal mortgages. GDVs are getting squeezed, so ultimately it's got to come back to the landowner and negotiating a sensible price in order to make the appraisal work. I think going into a new project in 2023 is no bad thing, because the first 6 to 9 months is going to probably be a little ugly, and then I think we'll start to see things stabilize. And if you're going into a scheme of 5 to 25 houses, flats, you're realistically looking at an 18-24 month project, and actually you've kind of leapfrogged and been on site throughout this year, when actually things, if you can lock in sensible finance, then you're probably in a good place. I think historically people coming out of projects Q3, Q4 2022, it's been a little bit more challenging because we all know the sales market's a little bit more sticky at the moment.
Thank you, Nick. And moving on from Nick to Simon, your views on the market
and central government. Best hadn't give my views on central government too much, but we've seen 12 or 13 housing ministers in the last decade. There's no way sensible policy can be delivered when housing ministers are changing so readily. So that in itself has had an effect on the housing market in general. Then with the economy as it is, of course, we were expecting inflation over the past couple of years as the post-COVID boom in the housing sector started happening, and then energy prices started increasing. So no major surprises there. Obviously, the last quarter of last year was a shock. Liz Truss, I don't know how she managed that. So where we're at now, interest rates have risen. We expect them to rise further, maybe up to around 5%. What we're seeing in the lending market, limited company buy-to-let, I feel is quite a good measure of where the finance market is. We're seeing rates of 5 to 7%, where 2 years ago we were seeing 2 to 4%. What's interesting is 5-year fixes. We're often seeing a little lower than 2-year fixes. So that tells you something about what the banks are thinking, that the market will settle down over the next 5 years and they can offer cheaper rates over a slightly longer term. So we're expecting a bit more of a shock to the system, and then for it to settle down. I don't personally think lending rates will go an awful lot higher, maybe another % or so, but I think we need to get used to this as the norm for the next few years. Build costs have been a big factor over the last couple of years, rising dramatically. We have seen them come back down a little bit. However, with energy prices as they are, it's unlikely they'll shift back down to anywhere near where they were 2 or 3 years ago. So that's something to bear in mind. We're starting to see a few more distressed sellers. We're starting to see a few more portfolio landlords looking to consolidate, and there's certainly some tension in the air. I think we'll see quite steady growth of the alternative finance sector over the next couple of years. What happened in 2008 and over the decade or so afterwards was the bridging finance market grew from, I think, about 1.5 billion up to about 7 billion per annum. And I think we'll see more of that over the next couple of years. Short-term finance, I see as staying at the same sort of levels that we're at the moment in terms of rates. So pre-COVID, we were seeing bridging finance at around about 0.5% a month. I think that was unsustainable. And where we're at now, the majority is sort of 0.65 to 0.85, 0.9. I think that's sustainable, and I suggest that we won't go a lot higher on that side. So that's my thoughts for the moment.
Sorry, off mute. Thank you, Simon. If you've got any specific questions you've got, put them in the chat box and you can ask those questions in a short while. So over to you, Michael, your thoughts.
Yeah, so I mean, the gents have already kind of covered off most of the points that I think all brokers share in regards to the interest rates and where the development of bridging market. Again, I think obviously our specialism has always really been in trying to be as creative as possible in terms of how we're structuring our deals. So we've kind of seen two things off the back of that, in that this isn't probably the best market to try and be creative in. So we've got to kind of think outside the box. So a couple of things we have really seen recently is lenders are really starting to tighten up on security. We used to be able to get pretty much anything through a bridging lender. There wasn't much that a bridging lender wouldn't say, oh yeah, okay, yeah, we'll have a look at that. At least one of them on the market would say, yeah, we'll have a look at that. It's becoming quite apparent that a lot of those are now under strict instructions to be much more diligent with their security. So security documents are substantially more ring-fenced than they were previously. Personal guarantees are now actually being looked into, so seem to have a little bit more worth than they did before. I'm sure many of you on the call that have signed personal guarantees before have probably signed PGs for way more than your personal worth, as many developers do. But we're starting to see some bridging lenders and some development lenders really cracking down on that and saying, look, we need to see X amount percentage worth within your personal guarantee in order to sign it away. We're also seeing a lot of bridging lenders and development lenders now becoming much more nervous of second charges as well. So they're trying to keep the leverage as low as possible, obviously, to bring their risk down as much as they possibly can. And also with debentures and whatnot as well, we're starting to see them become more stringent with their requirements around debentures, collateral warranties as well. When it comes to the other side of it, so we've got that side, which is the more strict security from lenders. However, what we are starting to see is actually more vendors being open to, for example, deferred payments. So we've got quite a few developments at the minute where we've had investors who have pulled out at the last minute. We've had to then obviously get deferred payments in place with the vendor. We've had lenders who are happy with that. Now, it may be that they're happy with that if there's no charge, for example, and there's a percentage shareholding being taken. Depending on the percentage shareholding, depends on whether they obviously need to re-sign any of the documents or whatnot. But we are starting to see a real uptick in terms of deferred payments from vendors. So I believe we've got 3 fairly chunky ones at the minute. One's for 768,000, one's for about 1.2 million, and I believe we've got another one that we're negotiating at the minute, which is about 1.8 million in terms of deferred payments. The one that's 768,000 was originally 263,000. Then an investor pulled out, so there was a renegotiation in terms of then increasing that deferred payment. The lender we're working with is strict, but actually has been fairly open to getting the deal over the line, mainly because the deal's taken probably the best part of 9 months. They're probably sick to death of it now, so we'll agree to pretty much anything to get it over the line now. So there's a lesson there. If you want to get your development lender to agree to something, take as much time as you can. But it really does show the direction of the market from a vendor's perspective, in that I think a lot of them are realizing that actually the prices that they agreed 6 months ago, 9 months ago, probably aren't going to happen again now, or even prices that they agreed maybe 12 weeks to 4 or 5 months ago probably aren't going to stick either. So I think there's a lot of scope now for a bit of renegotiation if things are starting to get a bit tight towards the end of the purchase process. So I think, yeah, it shows on both sides where lenders' heads are at and where vendors' heads are at.
Thank you. So moving on to 2020, specifically looking at the opportunities, between the three of you, you've got tens, if not hundreds of millions of deal flow that's coming across your desks, on a monthly basis. What are the trends and opportunities that you're seeing? Michael, you mentioned creativity and funding. What areas of creativity and focus are you seeing investors and developers looking at? And could you give us some insights on what those opportunities might look like? Starting, yeah, Michael.
Absolutely, yeah. So, I mean, a lot of you from the previous kind of 6 months will have heard me harp on about warehousing into co-working spaces. Absolutely still seems to be, maybe it's just because we're based in sort of the Lincolnshire, Norfolk area, and it maybe works better here than it does elsewhere. But very much at the minute, we are seeing a huge uptick in terms of people taking on large warehousing spaces and chopping it up and renting it out to either Amazon, drop shippers, small photography studios, even just small offices. So we've seen a massive uptick in that. We've seen a massive uptick in commercial conversions as well. Obviously, a lot of commercial space has been empty since 2020. A lot of people obviously cleared out during COVID and haven't come back. And while there are some city centres that maybe are picking back up, for example, Peterborough is not doing too badly on the high street, but there are many places like small satellite towns which have got large commercial high streets, like where I'm from, for example, in Spalding. We've got quite a large high street, which actually most of which is now empty. And Shaz, who I believe you guys know very well, Shaz Nawaz, is an accountant based around here, has taken on most of that high street himself to do commercial conversions. And there's a massive opportunity there, small commercial buildings into either we're seeing a conversion into whereby, for example, on what he's doing at the minute, he's cut off the front section of the commercial and is retaining that as commercial, then converting the rear of that commercial unit into residential and then the uppers into residential. So we're seeing that as well. We're seeing obviously a huge amount of deferred payments coming through as well. I say huge amount as if there's hundreds coming through, but compared to what we've seen previously, that's where we're seeing the big uptick. And also we're getting a big uptick at the moment in terms of below market value portfolio purchases as well, because there's a huge amount of landlords who physically cannot afford to refinance their portfolio going from 2.5% up to 5%. I'm part of a property development company where we've got quite a substantial portfolio. It's probably about 2.5 million. And I'm looking to take over that portfolio because we just, at the point where it comes to refinance, the other guys just don't want to be involved in it because it just doesn't make sense for them to stay in it. The margins go down. But for me, it's a long-term play. I know things are going to hopefully play out and be plain sailing again. But from that perspective, there's people like that who just want to shift off big portfolios. I mean, if that went to market, you're probably looking at a £2.5 million portfolio going to market for offers around 2 million just to get rid of it as quickly as possible in one go. So you look at that, that's a 20% drop. So there's some serious bargains out there at the minute. And we've got a developer that we're working with at the minute who we've spoken about many times, Mark and Nigel, who they are getting rid of all their developments at 80% now. They're just bringing someone in to purchase the whole development up front for 80%. And literally just then they go and do the development as the contractor. They take their contractor's profit. They know they've got 80% sealed in at the back end. There's no risk for them and they just move on. But for someone who's willing to take the risk, there's 20, 30% margins to be made on a lot of this stuff. And that's what we're seeing a lot of at the minute is people taking opportunities to take advantage of people who have maybe sat on their laurels a bit and have played it very safe for the last few years, who now unfortunately can't afford to do that anymore.
Great. Thank you, Michael. Nick, your thoughts on opportunities that you're seeing?
Yeah, look, I mean, last year was interesting because we funded some quite quirky transactions, and we've actually seen a few more in this space, and we've seen quite a bit of industrial being converted into studios. We know Amazon Prime, Netflix, massive things. I think they're pretty much taking over the planet at the moment. I'm sure we all watch them occasionally. And weirdly, a few of our clients have been acquiring industrial units, and the only change that needs to be made, bar maybe a touch up here and there, is actually strengthening the roof, because a lot of the equipment, quite heavy equipment's hanging from the roof, and they yield very, very well. And there are more opportunities by big players coming into that space. If you can find those kind of assets closer to major cities, there's a huge opportunity, and it's something that I didn't think we'd be saying we funded it at the start of the year, but there was actually huge appetite from the lending market. So a bit of a quirky one, but it kind of makes sense when you think about it. Student accommodation, far more sophisticated people in the market are saying there's still a huge opportunity in that space. I think year-on-year growth, or the cap growth year-on-year, was around 11.3%. So some pretty good statistics in that market. And look, I still think resi housing, ground up residential housing is a massive opportunity. There's still a huge demand. There's still a lack of supply. And I think affordable housing in that space in the right areas is still going very well. Lenders are, I'd say, offering the best terms on residential housing at the moment, because it's still needed across the country. To an extent, there's opportunities in offices as well. I think we're going to hear in the next, going forward, I think sustainability is going to be a word that we touch on a lot. There's new products coming into the market, both on the resi development side and also the commercial conversion side. And I think converting offices and retrofitting them and getting their sustainability up to a good standard is certainly an area of interest from a lot of the bigger funds at the moment. So LEXI personally, we're starting to do a bit more business in Europe, just because we see there's an opportunity there. I mean, take the student stuff. I think in the UK, every student, there's for one student, for 14 beds in the UK. Sorry, for one student in the UK, there's 14 beds. Over in somewhere like Spain, there's 31 students trying to get into one bed, which there's a clear undersupply out there. So we see that as a bit of an opportunity.
Great, thank you. And Simon.
So echoing what the guys have just said, we're seeing some light industrial. We're seeing, both from a development perspective, creating new light industrial units, and other people coming into warehousing and industrial and improving units, making them smaller, improving covenants by getting new tenants in, so often dividing up units and getting new tenants in and increasing the revenue and value that way. I guess with the continuing downfall of the high street, it's quite natural that there's more and more demand for warehousing, because there's a lot more online transactions going ahead. That seems to just be never ending and growing. More and more people get comfortable with buying online, so that makes sense. And then there's the commercial conversion aspect, as there's less demand for both retail and offices post-COVID. One area of opportunity that I'm seeing, and that I think people should be looking into, is trading businesses that own property, not necessarily not property companies, but trading businesses that own property, particularly if they've got land associated with them, where margins are getting squeezed for the current business owners with energy prices rising, with inflation. It might be time for them to exit, and there might be some repurposing to do. You might be able to add value to the existing business or add value to the wider site by getting planning for housing development. So I think that's a key one to look at. And one thing to really be mindful of is trying to put sustainability measures into new development, because in a competitive market and in a market that is that margins are getting squeezed, if you can put something in that ultimately benefits the end user for the long term, so if you put solar in, or ground source or air source heat pump in during the course of the development, that might not be a huge cost to undertake, but it adds a lot of value for a long term for the resulting purchaser. So I think that's something to be mindful of.
Great. Thank you, Simon. So we have got quite a number of questions. I'll tell you what I'm going to do with that, because I think you're all staying for the breakout sessions. We'll take those questions into the breakout sessions. So if you've got your questions out in the chat box, make sure you join the breakout session with the guys in, and you can ask those questions and have that one-to-one debate there. So as we wrap up this particular session, then could each of you close with, you see a lot of applications from property developers, and pretty much everybody on this call, 50 odd people on this call, are property developers. Could you give just one piece of advice that you think property budding and improving property developers should take on board to give them the best chance of securing great finance products? And can we go down the order again? So, Nick, one piece of advice to budding developers.
Yeah. If I can give two, that would be good. Look, I think firstly, due diligence. Due diligence is the key in this kind of environment. There's going to be down valuations, and to try and challenge that, you have to have some sort of comparable evidence to say, I don't think you're right. And that needs to be as detailed as possible. So I think that's going to be a key moving into this. And I think actually just working backwards in terms of thinking about, right, how quickly can I acquire and get on site from a development perspective? Probably start by thinking, right, what specification am I doing? Who's my demographic from the sales perspective? Because building assets is one thing, but not being able to sell them is not profitable for anyone. And obviously, listening to Jo earlier, it was commendable that she's got so many assets pre-sold, which is great. For me, I think looking at the sales strategy before even entering into the project is probably the biggest thing in this current climate.
Thank you, Simon.
I'd say prepare properly, make yourself investable. Imagine you're going on to Dragon's Den, because there's a lot of people looking for money, and banks, although they have a lot of money to get out into the market, they are being more cautious. So make yourself really investable. Write yourself a decent property CV, put in all the experience that you've got, bring in experience from your professional team as well that can support your application, and present your deal as if you're going to an investor. They're just the same as investors in many ways. They're going to do the same due diligence. They want to see that you're trustworthy, that you're transparent, that you've done your homework. So the more you can do to prepare that, and your broker should help you to do that, the more likely you are to get a quick decision and a good result.
Great. And finally, Michael.
Yeah, I think for my one, I'd even bring a step back and say, when you're looking for an opportunity, keep it sensible, because the amount of funding requests that we see for first-time developer looking to develop 120 odd units, and it's just unrealistic. It's not going to happen. I mean, that being said, the biggest development we funded for a first-time developer was 102 units, but that was a one-off and a bit of a unicorn. But in terms of your first development, try and keep it below, I'd say 12 units, I think is realistic for a first development. And I think keep expectations realistic as well in terms of build costs, time it's going to take in order to deliver that development, and the time to sell it as well, which obviously was a huge part of the case study earlier. So I think just keep everything realistic. I mean, there's far too much hype out there on social media, everything else, everyone achieving all these so-called incredible things that they've done. And I just think sometimes it's very, very dangerous to compare to others and to try and better someone else that you've seen on social media, because 9 times out of 10, what you see on social media is complete and utter bollocks. So I think keep it realistic, keep expectations realistic, and you'll do incredible things.
Great, some real sage wisdom from the guys there for anybody looking to take those next steps into property or extend their property. Is that an airspace rights opportunity over your left shoulder there, Nick?
We have vaguely scoped it out. I think there might be a rights of light issue. I think that's why it's not been developed. But central Soho, yes, it's throwing up a few opportunities.
Brilliant. Good. Well, look, Nick, Simon, Michael, thank you so much. Your wisdom. We work with all three of you. You're doing some great work out there and serving this fantastic industry. So thank you so much. If you want to ask your questions to Nick, Michael and Simon, and hopefully Adam and Rob will be back in the building after their fire alarm, they will go into the breakout rooms in a second, so you can ask your questions then. So thank you very much, guys. Really appreciate that.